The conference is now being recorded.
Thank you for joining today's investor call following the release today of Mount Gibson Iron's financial results for the year ended 30th of June 2013. Jim Beyer, Chief Executive Officer of Mount Gibson, will be leading the discussion and is joined by Chief Financial Officer Peter Kerr and Manager External Relations John Facius. Jim and Peter will give a brief overview of the company's financial results, followed by a question and answer session. Go ahead, please, Jim.
Okay, thanks, Susie, and good morning, everybody, and thank you for joining us for this discussion on our financial results, or probably good afternoon for some of you folks on the East Coast. Look, I'll quickly run through the highlights before handing over to Peter, our CFO, who will provide a little bit more specific commentary on the numbers, and then we'd like to cut straight to open it up for the Q&A session for people. Look, overall, I think we've had a very strong year, both operationally and financially. Of course, we went through some of the details operationally about a month ago when we released our quarterly, but we're very happy with the financial outcomes in this environment of volatility and changing conditions. As you'd expect, given our record sales of 8.8 million tonnes in the year just gone, we also generated record sales revenue of just over 850 million for the year, an increase of a little over 30%. Headline net profit after tax came in at 157.3 million, just under the previous years, although we do recognise and acknowledge that this includes a $64 million non-cash tax credit related to the mysterious MRRT tax, which I'll leave to Peter to explain and give some detail on a little bit later on. If we strip out that tax credit, our underlying net profit after tax was a healthy 92.9 million. The reduction was reflecting a lower average iron ore price in general in the market, and also our expanded product mix. And just to note that while the Platts 62% CFR price was on average 15% lower than the previous year, our average realised price was about 22% lower than the prior year, and this is reflecting the lift, as we previously flagged, in our sales of RSP and also the Tallering Peak lower grades for the year just gone. Importantly, our focus on business optimisation and improvement over the last 12 months is really starting to deliver in terms of improving our cash generation. Net operating cash flow, which is a strong yardstick on how we're actually performing, more than trebled at 179.7 million over the year, which does, I think, clearly highlight the merits of our strategy of maximising sales from our ore stockpiles and pulling back on expenditure while we fine-tune our existing operations, thus getting them up to a point of generating maximum returns. Consequently, we were able to increase our cash reserves over the 12 months by 83 million to land on $376 million effectively in cash by the end of June, the 30th of June. And that was after returning $40 million in cash dividends to shareholders during the year. Our total cost of goods sold held flat at around about $79 or $79.61 tonnes to be $79.61 per tonne to be precise, and that includes cash, non-cash and royalties. That number, I think, though, somewhat masks the success of our expenditure reduction over the last and cost savings program. We certainly delivered on the guidance we gave in October of cutting 140 million out of the planned cash spend for the FY2013 year. As we indicated, a large proportion of that reduction related to the deferral of waste stripping at Coolin while we worked out the plans and optimisation point at Coolin, and as you know, we're now undertaking a ramp-up program to take that to 4 million tonnes per annum. But more significantly, as we'd identified our savings, there was a significant amount of savings we were chasing on a permanent basis, and we successfully have created at least $50 million in savings per annum in the year ahead. And these savings reflect a number of initiatives. They roll out of a number of actions that we've taken or taking, substantially improved labour productivity, specifically at Coolin Island, and a subsequent reduction in the planned workforce, but also a number of waste and inefficiencies have been eliminated. Areas like light vehicles on site and a number of other areas where I think the reality was we'd grown a little bit fat. And the Koolan Island ramp-up is also complementing these improvements as with regards to the unit mining cost at Koolan. We've noted previously our guidance is $8 to $10 per tonne of material moved, and we certainly remain well within that range, in fact at the bottom end of that in the early part of this year, and we continue to drive ramp up at full steam. We're very confident of pushing that unit mining cost even lower, and we will maintain, as we get confidence in that, we will ensure that we provide the market with guidance adjustment at the appropriate time. In keeping with the board's view that shareholders should be rewarded when the company is performing strongly, and we can afford to do so, the board has decided to declare a fully franked cash dividend of 2 cents per share for the second half, meaning a full year distribution of 4 cents per share. I do note that once today's dividends, today's declared dividend is distributed later in October, Mount Gibson will have returned a total of $130 million in dividends to the shareholders in the last 2 years. Importantly, our business focus means we're looking to the future with confidence. As we indicated in the June quarterly report, we expect the coming financial 2014 year sales to be a stronger performance, with guidance between 9 and 9.5 million tonnes. This is thanks to the success of extending the life of Tallering Peak, upping the production at Koolan Island and optimising our stockpiles. And we're also very excited with the long-term potential at our exploration holdings both in the Midwest and the Koolan regions. Look, with that brief overview, I'd like to hand over to Peter, who will spend a little bit more time going through some detail on our numbers. Over to you, Pete.
Right, thanks, Jim. Welcome all. I'd just like to start with some high-level comments on the income statement and the balance sheet and the cash flow, and we'll leave any detail until there are questions. So just looking at the income statement on page 24 of the financials, our revenue from the sale of iron ore for the period was $852.9 million, which was obviously on the back of significantly higher ore sales across all products, 8.8 million tonnes sold. Our average realised price was 97 Australian dollars per wet metric tonne sold, and that reflects a blended average across all products, from the low-grade material right through to the high-grade standard material. In addition to, or included in that number, I should say, there's also a small amount of foreign exchange gains, and we have a modest foreign exchange hedging program on our Australian dollar conversions from US dollar revenue receipts. Other revenue was interest on cash balances. Cost of sales of $698.3 million, as Jim said, was about $79.60 per tonne sold, which was very similar to the previous year at $79.30 odd. The cost of sales reflects not only the cash expenditure and non-cash expenditure incurred in the year, but also the inventory drawdown. And on our stockpiles, we had around 2.2 million tonnes of drawdown, which had a carrying value, and that comes into this year's stocks, and we'll talk about that more when we come to the cash flow statement. The cash costs of the business, I would refer you to slide 6 of the presentation that we published with the financials. And just at a high level, what we've sought to do in this slide is derive from the accounting cost of goods sold and reflect the non-cash items out and add in our deferred waste mining costs, so our waste mining that is capitalised to the balance sheet, plus other non-cash adjustments, and we come to a figure of around $62 per tonne sold for the cash operating expenditure, including royalties. Excluding royalties for the year, that was just under $55 per tonne. In terms of, back to the income statement still, administration expenses, you will see, went from $23.5 million in the previous year to $30.8 million. That 30.8 does include a number of one-off items, including one settlement of a dispute, and the details are confidential, but I can say that our ongoing run rate for administration expenses we expect to be around $27 million per year, and that equates to, on this year's current guidance, around $2.80 to $3 per tonne sold. Just heading a bit further down, the finance costs of $7.3 million was the same as last year, and that represents around $5.3 million of cash finance costs on leases and our performance bond facility, and non-cash costs of $2 million, which is the non-cash interest that we build up on our accounting rehabilitation provisions. And then on to tax benefit and expense. Our normal tax expense, if you call it that, was around $35.6 million. But what we have been required to do under the Australian standards is recognise a tax asset or a tax credit associated with the MRRT starting base that we currently expect to utilise in future years to shelter us from having any MRRT liability. So it's a technical non-cash accounting requirement, but that MRRT credit of $64.5 million means that we had a slightly unusual looking tax benefit of $28.9 million. So with that credit, we had a net profit after tax of $157.3. If we strip out that credit, our underlying net profit after tax was $92.9 million. Just moving over the page then, a couple of pages onto the balance sheet, and very high level comments here. Cash movement is the key thing. Just to be clear, the cash we think of is both the cash and cash equivalents plus the term deposits. For accounting purposes they get disclosed separately, but they are cash. So our total cash went from $292.7 million at 30 June last year to $376 million. And that obviously will be reflected in the cash flow statement when we talk about that in a minute. Inventories, you will see there, reduced, and the reduction in our ore stockpile inventories was $53.4 million. So that's the carrying value that we effectively recognised in our cost of goods sold this year. Another point to note is in terms of loans and leases, so these are interest-bearing loans and borrowings in both current and non-current liabilities. Through the year we basically continue to pay them down. They are finance leases and HP arrangements on mining fleet items. And you'll see in the cash flow statement we made $21.3 million of payments to reduce those. So over to the cash flow statement now, which is on page 27 in the financials. Points to note, the operating cash flow, as Jim mentioned, $179.7 million, which is significantly up from the previous year and reflects the increased sales and the drawdown of stockpiles, which was an important feature of the year. We also paid income tax of $54 million. The company is in a full corporate tax paying position, and carry forward tax losses have been all but exhausted. Cash flows from investing activities, there is a line item there for term deposits. That simply reflects the movement between our operating cash accounts and our term deposits, but is irrelevant as far as thinking of our total cash movement. We did spend $42.4 million on the purchase of property, plant and equipment. Now at the half year, that amount was $31.3 million, so the CapEx spend was modest in the second half. And that included expenditure in the first half of the year on the completion of the Geraldton Port upgrade, and also on the Koolan Island footwall during the year, plus other mining fleet and infrastructure CapEx. I referred before to the repayment of lease liabilities of $21.3 million, as you can see, and also Jim referred to the payment of dividends in the year of $40 million of cash dividend. So we've now declared another 2-cent dividend for the final payment for this financial year just gone, and as Jim mentioned, that brings us to a total of $130 million paid in dividends over the last 2 years. So Jim, I think I'll leave it there, and we'll leave any detail to questions.
Okay, great. Thanks, Peter. Look, before we open, I hand back to Susie to open up for questions. Just a couple of comments on the market. Everybody should have as we would no doubt be aware, there's quite a varying view around the place. I think certainly the propensity is to jump on negativity, but we get a lot of information from our customers, both China-based customers and also traders who spend a lot of time there. And look, it's our view that we think there's a little bit of too much pessimism in the outlook. Facts are, I think in the long term, that demand will continue to grow at a healthy rate. It may not be where it was, but it's certainly going to be at a healthy rate, particularly coming out of China. And while there's clearly a substantial amount of new production that might be hanging around and planning to enter the market, history shows that a large proportion of that, assuming if it does or when it does come on, will certainly not come in at the timing that people are imagining, and it's certainly the way projects are going won't be as cheap as expected. So, look, we don't feel that the massive wall of supply, so-called, will come in, at least not in the timing that's anticipated. Looking at more of the short-term view and the concerns with some repetition of last year's so-called collapse, and I would point out that when the price dropped to below $90 a tonne CFR last year, it did that for 3 days, and it was actually below $100 a tonne for about 2 weeks. So I think, the point being that I think we saw there a significant overrun in a very short period, but obviously people have been spooked by that. We see it hard, and talking to our customers, to see a repeat of that, the buyers' strike that we experienced last year, or certainly not of the likes that we experienced. A number of areas, the stocks, the iron ore stocks at the ports, they dropped this time last year by somewhere of the order of 25, even 30%, but they have not risen since then. They have remained flat. We've also seen inventories at some of the mills. While that's got a little bit more movement in it, we just don't see the same overstocking environment that seemed to be around this time last year. Look at further to that, since over the last period, the last few months, we've certainly seen the value of the Australian dollar soften significantly, and our expectations, or the expectations, are that this continue to trend toward a long-term average well below the 90 cents mark. We put all of the above factors together and you can see the outlook for an established Australian-denominated producer such as Mount Gibson remains robust. So even though we are expecting price to remain volatile, we are anticipating that in US dollars the iron ore price will remain moderately strong over time. So our outlook is quite positive. We see a strong, particularly in the next 12 to 18 months, we see a strong outlook for the price. And when longer term, we maintain a strong view on the price as well, and and see the price staying in the range between $100 and $110 a tonne. So look, without further ado, I'll pass back to Susie and we'll open it up for questions.
Okay, thank you. Now, due to time constraints, only our institutional investor participants will be able to ask questions, while other participants will remain in listen-only mode. A recording of this call will also be available via the Mount Gibson website shortly after completion of today's teleconference. So for the institutional investor participants, if you'd like to press star 1 on your phone keypad to ask a question, this will place you in a queue. In the meantime, we do have Paul Young from Deutsche Bank. Go ahead, please, Paul.
Yeah, good afternoon, gentlemen. Jim, without a doubt, your biggest swing factor in costs is mining costs at Koolan Island. So I'm interested in your comment on that you think you can get your unit costs, or hoping to get your unit costs well below that $8 a tonne. So can you talk through how you're going to do that, and maybe just comment on shift rosters, truck cycle times, maintenance costs, what you're doing there to get that unit cost down. And I'm also interested in when the material movements at Koolan Island start actually decreasing, will you lose any economies of scale, and therefore will your mining costs actually go up as a result? And just lastly, you talk about exciting exploration potential at Coolanow and Extension Hill. I'm actually very interested in what that means for Extension Hill, considering you've got 3 targets below the Extension Hill mine at the moment. What's the concept there as far as potential and resource and potential and mine life extension? Thanks.
Okay, Paul, thanks. I'll break those up into 2 parts. The first question is around the mining cost, and we've given the guidance of mining cost per tonne moved of $8 to $10 a tonne, and we're certainly experiencing those levels at the moment as our overall material movement on the island lifts and our productivities lift. So we are very positive about being able to do a little bit better than that guidance, but as it stands, we leave the guidance as it is, and we'll wait till we get a little bit more confident that we can sustain levels, and once we do, we'll let people know. In the meantime, it's 8 to 10. What's driving the cost reductions? Well, it's the unit cost reductions. There's 2 things. First of all, there's absolutely no doubt the unit cost benefits from an increase in physical activity. There are a significant amount of any mining operation, but particularly at Coolin, we have relatively high fixed costs. So the more tonnes you move, you still only have 1 general manager, you still only have 1 HR manager. The more tonnes you move, the lower their impact is on the variable unit cost. But Coolin is also an interesting beast in that it has a regular daily services, for example, or every day and a half, I think, on a barge, and that's not a cheap little exercise. So certainly at the moment, as we increase our physicals, the unit costs come down. Look, I could also run through TKM factors and haul factors and equipment availability, equipment utilisation, but look, I reckon we'll be getting into too much detail. Suffice to say that there are a number of fronts that we're driving to get productivity up, and we are achieving that. Increased utilisation of our existing equipment fleet is one of the keys. The other is finding the equipment that we're not utilising and not only not using it, but getting rid of it so we don't have to bear the costs. Strip ratios and what happens as we start to come at the back end as strip ratios come down and the volumes move. Look, there's no doubt that the flip side of what I talked is driving down the unit costs. If we don't manage that carefully, we will see an increase in unit costs as we start to decrease the volumes of material moved. The advantage for us is that as we start to pull down that activity on the mine starts to basically, as I used to say in the mining game, slips into angel gear, into neutral, and just coasts downhill. You can be a lot more on the front foot in reducing your costs. We will be taking a very close focus on the fixed costs at that stage of the business. That's probably about 2 or 3 years out, really. We're already looking at, and I mentioned the barging, for example. That's a high fixed cost, bringing things in and out every day. That's an area that we're looking at to get more efficient at, so we can cut those costs. But at the moment, our focus is to drive up productivity and really get our unit costs by that technique. But we certainly have an eye on making sure that as the physical activity starts to drop in line with the reducing strip ratios, we will be taking the scalpel to our fixed costs so that they come down proportionally. Mine life extensions, Coolin Island and Extension Hill. Look, Extension Hill still remains our exciting area. We've got the Iron Hill, Mount Gibson, and Gibson South and Extension Hill. Extension Hill, that's right. Extension Hill South are the 3 colloquial names for the targets that we've got. We still have programs there. We've got our permit of works in. As we've mentioned before, it is an exciting area for us, but it's also, we've got that whole region has got some environmentally unique aspects to it, and we need to make sure that we're doing that in a manner that doesn't compromise our reputation and also works through the appropriate clearances. So, we we anticipate that we'll be able to proceed there, but we know that every now and again we'll hit a gate that we're going to have to work carefully through with the various government departments, but we're confident that that will continue to progress, and we're working on that together with our with Asia Iron, who also have a very strong vested interest in getting that work progressing. So we're all working together to push that forward. In terms of the Koolan Island opportunity, we've got Koolan South, and we've done the helicopter surveys on the Koolan South area. We're also going back. We've got fresh exploration folks in the team. Anybody that's a geologist, I hope, won't take offence to this, but geology is an art, as we know, not a science, and you can get two sets of eyes looking at the same ground, and we've realised that if we go back over Koolan, there's actually some things that where previously we'd said maybe there's nothing there. We're now looking and saying, well, maybe there are opportunities. So there's a few little flickers of opportunity on the island itself that we're having a look at, but you know that sort of thing wouldn't impact on the business, on the Koolan Island business in the next couple of years. But it's as we get more information there, we'll let you know. I mean, it's, as you know, Paul, it's pretty risky territory when you start putting tons and grade on something that hasn't even had a drill bit put in it. So we'll defer to the conservative approach and let you know when we know a little bit more confidently. I hope you understand.
Yeah, that's great detail. Thanks, Jim.
Thanks, Paul.
Thank you. Just as a matter of note, if any participant feels that their question has been asked, they can press *2 on their phone keypad. I'd like to introduce now Michael Evans from CIMB. Go ahead, please, Michael.
Oh, g'day, Jim. Thanks very much. Just on your cost savings, your $140 million and your $50 million on a permanent basis, can you sort of flesh that out a little bit more, and in the context of your accounts, I suppose, if you look at your expenses on your expenses, your cash, your payments to suppliers, etc., that's gone up a little bit, and obviously that's got to do with strip ratios, etc. But can you just sort of put those cost savings in the context of the accounts and how we should think about them going forward? And on the capital, you mentioned that the second half was $11 million. Is that $20 million what we should be thinking about for the next couple of years per annum on capital?
All right. Well, look, I'll let Peter in a sec talk on the capital, but I'll just to touch on the operating cost piece, and it's a good question. Actually, when I think of it's a good question, I remember reading somewhere in the paper, if somebody ever answers your question by saying it's a good question, it means it's one they don't want to answer. But we do want to answer that one. Look, the $140 million was out of last year, and understand the context of what we were talking about with those costs was it wasn't relative to what our costs had been in the prior years. These were all costs that we were anticipating we were going to need to spend. So last year we pulled $140 million of costs out of what was effectively our forecast or our budget for the year, and we pushed it timing-wise. We pushed the stripping around. Included in that was what we anticipated were $50 million that we could pull out of our costs permanently. So if you go and you're looking at the historic accounts and saying, well, where did that come out, where is that reflected? At the end of the day, when you're talking about costs that you've reduced from your business and pulled out of your business, you can't go back in history and pull them out. What we're saying is that if we hadn't have done this exercise, our costs this year would be at least $50 million higher than they will pan out to be. So the best way to illustrate what that would have looked like, we've currently given guidance for mining costs at Koolan of $8 to $10 per tonne of material moved. If we hadn't achieved the savings and the productivity benefits and the cost outs that we've already achieved now, or have got actions underway to pull that out over the next few months, that guidance wouldn't have been $8 to $10 a tonne. It would have been more like $9.50 to $12 a tonne. So what we've been able to do is to reduce our costs going forward. We haven't been able to go and pull costs out looking back. I hope that makes some sense.
Yep.
In terms of the capital, Pete, you want to?
Sure. So Michael, on the capital, we have given guidance for the Koolan Island operation, which is where the bulk of the capital is incurred, and that guidance is for $10 million a year for the footwall geotechnical support. Plus, earlier this year we gave guidance for other sustaining capital items, which is around the $8 to $10 million mark per year as well. So there's circa 18 to 20 for Koolan Island. To the extent that we purchase items of mining fleet, in the past we have leased financed those, and we would anticipate doing that, although it may be appropriate for us to consider buying outright those things. But at this point in time, the fleet strategy for Koolan is on a basis of no net cash out. It's a finance arrangement. In addition to that, the CapEx in the Midwest is relatively modest because Tallering Peak ends in a year or so. The rehabilitation provision there for Tallering Peak is around $9 million, and we would expect to spend some of that in this current year and in the rest when the operation ceases. And Extension Hill's capital expenditure requirements are modest as well, up to a few $1 million per year. And so the capital really in the business is linked into Koolan Island.
Great, thanks very much. And just while I've got you on exploration expenditure, how much, I mean, you've got a few sort of things you're obviously looking at. How much are you spending on that over the next couple of years?
The budget that we have in mind for the current year is between $5 and $8 million. That will be entirely dependent on operations or the success of the drilling. But at this stage, that's the plan in mind for the next 12 months.
Great, thanks guys.
Thank you. Our next participant is Matthew Hodge from Morningstar. Go ahead, please.
Hi guys. Michael sort of asked the questions that I wanted on maintenance capex. So I was just wondering if there are any major fleet replacements coming up, and would that be expected to have any impact on your operating cost per tonne? Because obviously, if you're leasing, then it's going to be an operating cost. So should I expect any change on that front?
Matthew, look, it's Jim. We have fleet replacements. We have a fleet replacement program mapped out as part of our, and frankly, it only really applies to Koolan Island, which is the place with any material fleet. Our current plan or our strategy at the moment is to maintain the historic one, which is any major replacements of big equipment will be financed. And if we had any plan to change that, we would certainly flag that to the market because that would have some impact on cash flow.
Okay.
Thanks, Matthew.
Thank you, Matthew. Our next participant is Philip Chippendale, Wilson HTM. Go ahead, please, Philip.
Hi, guys. A couple of questions. Just firstly on Tallering Peak. Can you just walk me through the ore sort of breakdown for T1 and T6? I think T1's around 0.8 million tonnes. How much remains in T6? Just trying to see exactly when the mining will finish up there. That's the first question. The second one, again, just on Tallering Peak, you've said that sales will slip into September 14 quarter as well. Just wondering how much we should expect to see sort of slipping into that quarter there. And then thirdly, just on the cost side of things, Peter, maybe one more for you. Just the transportation costs on a unit basis look like they've jumped up in the latter half of the year. Perhaps you can just talk us through the drivers behind that. Thanks.
Sure, Philip. Back to your first questions. The plan for the current year for Tallering Peak, you're right, T1 has a reserve of about 800,000 tonnes, and we would expect that to be mining completed by 30 June next year. The main pit, the historic pit called T6, at the moment has about another 1 million tonnes in it. And in addition to those tonnages, there of course are existing stockpiles as well.
Okay, but that balances 700,000 tonnes, which you've said you should be selling in FY14. So is the material that slips into the September 14 quarter, is that sort of just a very small amount?
Yes, that's correct. So we're expecting that to be remaining stockpile at 30 June to be sold into the following financial year.
Okay.
So all of that information, Philip, is in the quarterly report as well. There should be you should find a description of the plan for the year.
Yeah, thanks. And just on the cost side of things?
Yeah, look, the cost side of things, the transport costs, if you're wanting unit rates, obviously the unit rates are behind the numbers that you see that we've disclosed, but we have road and rail transport costs. From Tallering Peak, the cost on the road is around $7 or $8 per tonne. The cost on the rail is similar, and that's to get it into the Port of Geraldton. For Extension Hill, the cost on the road is around $9 to $10 per tonne, probably towards the lower end of that, and the cost on the rail is $17 or $18 per tonne. We had, during the period, and it's recognised in the numbers here, some invoices that we needed to settle from prior periods, and so that's why you might see a little kick up there, but the unit rates I've described are relevant.
Yeah, I think the unit rates as well, it's Jim here, Philip, the unit rates comparing year on year would be higher now because we're just generally moving more volume out of Extension Hill than we did proportionally, so the weighted average would be coming up.
Okay, thanks, guys.
Thank you. Just as a reminder, if you feel your question has been asked, you can press star 2 on your phone keypad to remove yourself from the queue. So I'm now introducing Glenn Lawcock, UBS.
Hi, afternoon. I just wanted to ask a little bit about Koolan Island and your comment in the release that unit mining costs were $8 a tonne approximately in July. We had a call only 3 weeks ago where you said, you know, I'm trying to find the exact numbers, but I think you said costs were, you know, you were aiming for 8 to 10, but we're not there yet. We'll finish fiscal 14 at $8. But so I'm trying to understand how I match your comments only a couple of weeks ago where you said we're not there in that range, yet now 3 weeks later we're there. You know, you said July is 8. So is it going to go back up in the next couple of months and then tailor back down, or is 8 just the magic number that we've all of a sudden happened at because you've been very successful? Just trying to gel the comments from 3 weeks apart.
Yeah, Glenn, it's Peter. I'll respond to that one. The numbers we saw in May and June, which is what we were talking about a month or so ago, were down and not yet in that range. The numbers we saw for July, which obviously have been finalised only in the last week or two, were in that range towards the bottom end.
So your basically is there anything special in July that got you there, or that that maybe reverses out, or do you actually was there now? So your comment about getting to the bottom end of the range by the end of the fiscal year has been brought forward 12 months.
Okay, no, I would say be cautious as we are about 1 month specific performance. We're encouraged that July was there, but that was due to improving costs, but also increased volumes. And as those volumes increase, then we'll want to see where those costs map out. So we were comfortable with July. If we can keep it at that type of level for the rest of the year, we'd of course be very happy, and hopefully we can get it less than that type of level. But give us a quarter or two to get the performance recorded properly.
But clearly it has stepped down faster than you thought.
Look, I think that's the feedback. Clearly, we're very happy because I think we say in the commentary the way that the productivity's come up. One swallow doesn't make a summer, but we're certainly encouraged, and I suppose what we're saying is that we'd hope that trend will continue, and that the next opportunity for us to give you an update on how that's going will be the September quarter. So but at the moment, as I think I said, what we're seeing is a very positive trend, but we are not prepared to change the guidance yet from 8 to 10 because it's a month's activity. But if people usually want to know how we're going, and we're pretty happy with the way we're going.
Do you have any sense of August? 75% of the way through?
We don't track our costs on a daily basis like that, Glenn. Usually things can swing pretty wildly. You can track general usage items like fuel that's been consumed on the island, but as you start to go through other aspects, it's just not practical to do that. So it won't be. It'll be at least another probably 2-3 weeks before we've got some idea of how August pans out. By the time we close the accounts and look at it, but we won't be. We won't be doing anything more on guidance now, and giving any update until we see all you folks in the September quarter financial physicals.
Yep. All right. Thanks very much.
Okay. Thanks, Glenn.
Thank you. Now we have Mark Buditel, JP Morgan. Oh.
How you going, Mark?
Mark, did you want me to clear you from the queue, or do you have a question?
Oops.
I think we all need a minute together.
Sorry, we lost that participant.
Right.
We lost that participant.
Okay.
So unless we have more further questions, if anybody would like to press star 1 on your phone keypad, thank you. Peter O'Connor, would you like to go ahead, please?
Jim, Pete, good afternoon.
Okay.
3 questions. An easy one first. Lump premium. Just looking for an update. On the quarterly, you talked about the lump premium. You talked about it being 14 cents and how it had moved higher. Given the tightness in markets lately in China, as you mentioned, what's the demand been like for the high-grade products, particularly yours, pellet, and has the pellet premium moved again, and do you get a sense where it's going from here? That's my first one.
Yep. Okay. Good. Can we answer it first and then?
Yep. You go with that one first. Yep.
Okay. Look, one of the things to recognise in our contracts, the vast majority of our product is tied up in life of mine offtake agreements. There's only about 20-25% of the product from Extension Hill that is unassigned, and we actually prefer that way because we sell that into the spot market to make sure that we're keeping our finger on the pulse of what's happening. We're not seeing a preference one way or the other away from high grade to low grade. I think we're probably finding a little bit more interest or significantly more interest in the low grade sales, although I know 18 months ago we were able to make low grade sales if we wanted to as well. We just didn't because we were rail constrained at that stage and were pushing high grade out. So we see demand at the moment for all products. In terms of the lump premium, I think there's on the high grade, good quality lump. There's certainly the premium is there, and while the customers make noise about the lump premium, they will always they're prepared to pay it. I mean, customers are like we all are. You might grumble about it, but at the end of the day, it's still being paid.
My next one's thinking bigger picture, and you talked about this on the quarterly call as well, M&A. Things are, if anything, getting cheaper in the targets that you've mentioned for quite some time. Thoughts, a growing cash pile, small divvy, M&A, where are your deliberations at?
Our deliberations are progressing quite well, thanks, Pete. We don't plan to issue a list of what we're looking at, what we're considering. I know that's a facetious answer, but you know quite well that we're not going to give any specifics. I think your observations of the market are absolutely correct, although probably in the last couple of weeks we've seen some firming in prices in a few interesting areas. But the opportunities are certainly there. The dogs are still out there. There might not be quite as many of them, so we've got to be careful we don't get ourselves caught up in that. But we are certainly looking in that space.
And lastly, and more philosophically, thinking about some numbers. Your market cap today, 757 million. Your cash balance about 376 per the accounts. Gives you a EV of about, call it 400. And per your presentation, EBITDA of 330 million. What do you and Pete think about that and the board as well? And how do you bridge that gap between what should be a different metric on value for your amount of EBITDA?
Yeah, look, another good philosophical question to end up on. Thanks, Peter. Well, what does it do? We're not the only campers in this. I think this is probably realistically an issue sitting certainly across a lot of the miners at the moment. It does generate a level of frustration of perhaps the market not recognising the value there. I think as long as there is the ongoing negative sentiment at every turn about what's happening with the iron ore price, there will be this subdued valuation markup or issue, however to describe it. I mean, every time you read an article, the price of iron ore goes up for 2 weeks and it barely gets a mention, but it drops in a day, and all of a sudden you've got a multitude of reports coming out again saying it's on its way down again. I don't think that contributes a positive sentiment. I can complain about it, but that's the reality. We just have to live with that. I think the other piece of the value on our business is that, quite frankly, people they're watching to see what we do. There would be an element of uncertainty and in some areas concern that we've got a significant amount of our money is in the bank, and are we going to do something with it that is a good decision? We believe that we will. We have a very careful hurdle of decision point as to what return we will be looking for if we take that money and invest it outside of where we've got it at the moment. And I guess one of the points that I was making at the Diggers and Dealers conference was that I'd like people to look at our record of performance and consistency in doing what we're saying we're going to do, and our ability to eke out value, and to recognise that same discipline and that same approach is what we are using against to assess the M&A opportunities. So, I think in the end our people are watching to see what our actions are. So we can talk and we can make noise, but to me that's what the issue is, what the challenge is rather than the issue.
Could I just round off by asking on dividend? The payout ratio roughly comes out at about 50% for the year just gone. Peter, we think about it as a payout ratio on earnings, free cash, or is there any other way we should think about what happens with dividends going forward as a way of taking some of that concern off the market about what you may or may not do with the cash?
Peter, it's Pete. The way I think about it is, and I can just repeat the board through the chairman's comments, is that there's no formal policy. The payout ratio over the last few years has been sort of 20% and up. The board's approach is if we are continuing to make profits and running the operations well and we can afford to do so, we'll pay the dividend. So there's no set percentage of NPAT or cash flow that we're talking about. So I think it can be just considered in that context for the moment.
Thanks, Pete. Thanks, Jim.
Thank you. We now have Chris Drew, Royal Bank of Canada. Go ahead, please.
Thanks. Afternoon, guys. Just on the destocking for the December half, are we likely to see kind of, a repeat of that, of what we've seen in the June half, and I guess tied in with that, your ability to continue the mine gate sales and perhaps rail ore out essentially in excess of your allocation there? Is that likely to continue for much longer? Thanks.
Yeah, sure, Chris. You mean, are we continuing the strategy of trying to draw down and sell the stocks?
Well, the volumes, I guess. What sort of...
Yes, because in particular at Extension Hill, we do have sizable stockpiles still, and at Tallering Peak, we have stockpiles, in particular the lower grade material. And while that material at Tallering Peak does have a carrying value and it won't contribute that much to profits, it will contribute to operating cash flow. because obviously to turn it down the line and just sell it is a pretty modest cost relative to what we would be able to sell it for. So yes, we would continue to sell down stockpiles to the best extent we can. At some point we will reach the position where the stockpiles are really the working capital requirement for the best operations, and we're not yet there for the Midwest. In terms of the mine gate, the sales opportunities, Chris, we have no contracted volumes of those of any substance, and they're just purely opportunistic. So we don't really feel it's appropriate to make any kind of forecast on what that might look like, because frankly it's almost hand to mouth, and maybe it depends on the customer, and we're not prepared to make that call. So our guidance is nothing.
Okay, thanks.
Thank you. And our final question is from Mark Bridgetel, JP Morgan. Go ahead, please, Mark.
Yeah, hi guys. Can you hear me this time?
Yeah, we can, Mark.
I just wanted to make the point that whatever came out of the call before wasn't coming from my end. But look, just a few questions from me. You talked about an average realised price for the year of 97 Aussie. I'm just wondering if you can give us what that was for the three products, for the lump, fines and RSP. The second thing is, just with your cash balance of 357 mil now, just wondering if there's any thought into potentially increasing that dividend. The amount you're paying out of that cash pile is relatively small, particularly considering how much cash you're making. And then lastly, just with Tallering Peak getting close to the end of its life, any thought or interest in what you could do with the port infrastructure through Geraldton once that's expired?
Yeah, okay, Mark. Look, the first one, giving a split, I think, on the $97, probably the best way to be, we've previously indicated that RSP is worth about $50 a tonne. I think there's a table in our release that outlines the difference. But look, frankly, the lump premium, I think, is running around about, it varies, but say 6 to 7.5%. So the split, you can see there's a price differential there. Peter, you got any more detail there to just throw on that?
Oh, look, Mark, I'll just add in our quarterly report, we put out a realised US dollar price for our fines product, and this is obviously an FOB price, so you need to make sure that you're taking into account the shipping costs are outside of this. For the full year, it was $108 US per tonne for the fines, and Jim's already mentioned $50 US per tonne for the RSP, and that 108 would have a lump premium applied to it for the lump product, and obviously varies over time. Most of our contracts are either month of shipment or month prior to shipment pricing.
And just so I can clarify that, those are DMT prices, right? So we'd have to take some sort of moisture off that as well.
Sorry, yes. So the prices that that's a good point. The prices in the quarterly report are DMT prices. The price of 97 that we talk about being the blended average for the total year is a WMT price. Our moisture levels, though, are fairly modest. They're lower than the Pilbara levels, probably less than half. Yeah, 2 or 3%, I bet. Two. They vary between 2 and 4%, but mostly in the 2 area.
Mark, the other question,
cash and dividend.
Oh yeah, look, I think the question on dividend payout and what we do with the cash was pretty much answered by Peter earlier on. At the end of the day, the board has no policy on payout. It assesses it as it sees our profitability and makes a decision on the information rather than locking in any kind of policy. And that's the way they plan to keep it for now. Just a reminder to people, and we announced this back at the half-yearly results, but the dividend payout now will only be on an annual basis. There won't be there's no plans to declare it on a half-yearly basis. So the next time we declare a dividend would be probably this time next year. And you had a question on Tallering Peak end of life, which
Yeah, just the infrastructure, what you plan to do with it after Tallering Peak's ended.
Yeah, look, okay, thanks. The port The port infrastructure would continue to be used for the extension hill, so the shed facilities at the port. The crushing and infrastructure facility at Tallering Peak would obviously, the other aspect that we're looking at, we have identified T1, which was on our own ground, but we're in the process of, and have been for quite some time, looking for other opportunities in the Midwest region to be able to treat our existing ops as hubs, for want of a better description. So there's a couple of opportunities that we're looking at in the region around Tallering Peak, where we may relocate the crusher, or we may truck run of mine for crushing and processing at the Tallering Peak operation. We also have earlier this year we did the transaction on the Field Spine project, which is a moderately grade DSO product that's about 60 k's north of Extension Hill, where 60-70 k's north of Extension Hill, where we're about to undertake a drilling program there as well, and that would be more feed for feeding into the Extension Hill infrastructure, and then that would flow through the rail and down to the port. So we're looking at both internal resource and reserves growth, and we're also looking to opportunities that are within a reasonable trucking distance from our infrastructure in the Midwest.
Okay, great, thanks.
Okay, so that was our final question. We have no more to go. Are you quite happy?
Okay. Well, thanks very much, Susie.
Thank you.
Look, I'll just in closing, look, I thank everybody for joining on the call today. I realise it's particularly busy over the last few days, really. I'd just like to say we are very pleased with the strong performance that our operations have been able to deliver. There's a lot of focus that has been undertaken and continues to be done on our business efficiencies and looking to get the most and protect our operations from the volatile market conditions. Certainly, rest assured, we remain committed to this approach and look forward to the next opportunity in maybe 2 or 3 months' time to update you on how this first quarter has continued to progress. So thanks, everybody. Have a good day.